excited to share this panelist with you today. We are talking about institutional DeFi, drivers, trends, and adoption. So hopefully you guys are all in the right room, came to the right place. So this exclusive panel is brought to you by Fidelity Center for Applied Technology and the Boston Blockchain Association, where the partnership has been very fruitful for both sides as we like to engage deeply with the ecosystem, and Boston Blockchain Association allows us opportunities to do that and bring great panelists like the ones that we have today for you. Today's conversation isn't theoretical, it's very timely, and it's tactical. It's being led by experienced voices that are actually shaping what's happening today in the markets. But before we meet our panelists, let's take a moment to ground ourselves in where Fidelity is and where we're going. Fidelity was founded as an asset management company with a long-term investor mindset, which continues to help drive our growth. This is not corporate messaging, it's in our DNA. From our earliest days managing mutual funds to today's digital asset portfolios, we've always believed in building solutions that stand the test of time. With that same long-term commitment, it fuels our work in crypto. Fidelity was an early adopter. We saw the potential to strengthen the financial well-being of our customers in new, meaningful ways. Our team and FCAT are doing exactly that. We're building, we're experimenting, and we're igniting the future for our potential new customers and new generations. We began exploring blockchain in 2014. Fidelity Charitable in 2015 was the first major charitable organization to accept digital currency donations. FCAT kicked off the first Bitcoin mining experiment, and at the end of it, it was all to really understanding the underlying mechanics so that we could continue to build for future results. Fidelity continues to expand its digital asset offering and capabilities to meet evolving client needs. I want to set the stage with a few trends that we're seeing specific to today's topic. First, DeFi has matured beyond its Wild West origins. Second, adoption is accelerating, but it's not uniform. And thirdly, regulation is no longer a barrier, it's becoming the catalyst. So why does this matter? The next chapter of finance isn't about replacing banks, it's about reimagining how value moves, settles, and accrues in a digital-first economy. And institutions are no longer spectators, they're architects, they're allocators, and they're agencies of trust. In honor of Women's History Month, I want to share a story for you to carry throughout today's conversation. Imagine this, you're outside on a brilliant sunny day, you pull out your phone, you want to reply to a message, you want to navigate to the next location, or snap a photo. You look at your screen and you see nothing but the trees, the sky, a glare, reflection. Frustrating? Not anymore. Because decades ago, in a quiet lab at General Electric, a scientist named Catherine Burr-Baguette did something extraordinary. In 1938, she invented a non-reflective invisible glass. It was a thin coating that's nearly undetectable, yet powerful enough to change everything. At the time, it looked like a footnote in material science. Today, the same invisible layer lives inside every smartphone screen ever used outdoors, every camera lens that captures sharp images under a harsh sun, and every microscope revealing secrets invisible to the naked eye. It didn't shout, it didn't dazzle. It simply worked, quietly, brilliantly, enabling revolutions we now take for granted. The most transformational breakthroughs rarely announce themselves with fanfare. They begin as whispers, subtle, technical, even boring to the untrained eye. And yet they become the foundation upon which the entire world will rebuild. And that's where blockchain is today. It's about reimagining how value flows across borders, across markets, across generations. Now let's turn to the remarkable group of leaders who will guide us through this critical conversation. Moderating this dynamic discussion is Karen Knox, SVP, Emerging Technology and Infrastructure at Howden, a leader at the intersection of insurance, fintech, and blockchain innovation. Joining her are two powerhouse voices, Cynthia Lopez-Sett, head of Fidelity Digital Asset, leading the charge in bringing institutional-grade digital asset strategies to Fidelity's global client base, and Olivia Von Business Development, Tokenization at Ava Labs. And please note, panelist LaDon Stewart was unable to attend at the last minute. And with that, I'll pass over to Karen.
Welcome everyone. So excited to be back here at Fidelity, reiterating Emily's words. The partnership between Fidelity and BBA is a strong one, and we genuinely appreciate all the support that we have from Fidelity. Thank you. And Ray, thank you for the short chairs last time. It was a little awkward for a ticket and then 12 chairs. So the format of today is we'll have our panel discussion and leave the last 10 to 15 minutes for questions. Please make notes for all of you who are in here. Hold those questions. We want to hear them at the end. And then something a little unique in today's format is that while we do have Chatham House rules, Fidelity is streaming this live. So for those of you joining virtually, please go ahead and share your questions throughout, and those will be shared at the end, so we will get to them. And with that, let's get started. So while you have brilliant introductions, and I feel like most people certainly know Cynthia sitting here, would love just high level, please tell me what you do beyond your title.
I think one of the favorite jobs that I have under my responsibility is to be the evangelist for new technology and change. And how is it that we can embrace the opportunities that this new technology is going to allow us to see more efficiency in the way that our markets operate. We have heterogeneous markets, they're not all the same. And this technology will continue to proliferate that ability for a variety of assets to be able to be brought on chain. And then using my asset management lens, how we think about how we can construct portfolios now with that broader range of assets and provide more of that personalization to investors across our platforms.
Hi all, pleasure to be here. My name is Olivia Vanderwood, as mentioned earlier. I am responsible for tokenization efforts at Apple Labs. Apple Labs supports the growth and adoption of the Avalanche blockchain network. And what my remit really entails on a day-to-day basis is working on the one hand on the supply side of the equation and partnering with top-tier asset issuers on bringing a variety of products onto the Avalanche blockchain network. So think tokenized money market funds from the likes of Van Eck, or BlackRock, or Franklin Templeton, as well as some private credit opportunities from the likes of Apollo, and everything in between, KKR's Healthcare Growth Fund, and other assets that have demand in the ecosystem. But where I'm really excited in the realm of tokenization is on the demand or distribution side of the equation. And so working with, on the one hand, fintechs that may have an appetite for stablecoin yield products or for tokenized US equities infrastructure, or with allocators, again, a range of funds, be it DeFi, quant, yield funds, and everyone in between may have an appetite for tokenized assets or RWAs. I have my beef with that specific term, seeing as in my previous life, I was investing in small mid-cap bank stocks at T. Rowe Price Group, and obviously RWAs have a very different connotation in that context. So anyway, very, very nice to meet you all, and excited to be here for this discussion.
Beautiful. So in the span of just not even 12 months. Last year at a summer social and panel discussion that Fidelity put on with BBA, where we had two discussions. We began with a discussion with Patricia Haas-Cleveland, which was very positive. In our second panel, it seemed like, okay, we're going to relegate DeFi over here. It has its place, but we're just going to relegate it over here. And so in preparation for today, we talked about, wow, this is more integrated. So just tell us, in the last 12, we'll go 12 months. In the last 12 months, what are the biggest changes that you've seen to really drive DeFi adoption?
Absolutely, happy to take it away. Well, first of all, I would say I feel like we've been saying we're 2 years away from institutional DeFi for 5 years. But what has really changed in the last 12 months really spans, in my view, 3 pieces. One is the compliance stack has evolved meaningfully. Second is the capital math. We can dig more into that. And then the third is there's just more proof of concepts or actual live and in production use cases that are coming into the fold. So on the compliance side, I'm really excited about emerging protocols like Aave Horizon, for example, that are emerging and really paving the way for more institutional DeFi at scale. For those of you who may be less familiar with Aave or Aave Horizon in particular, they're really solving the issue that has kept institutional capital on the sidelines, in my view, and that is how to do things like post tokenized funds as collateral in DeFi lending markets where anyone typically can liquidate your position, or your receipt token could very well end up, in a wallet, any wallet in the world. Obviously, that kind of uncertainty is very nerve-wracking for institutions and not legally usable or feasible. And so Aave Horizon is enabling more of permissioning in terms of restricting it such that the environment only includes KYC counterparties, for example, that can do liquidations, or making receipt tokens non-transferable, and really crystallizing a lending structure where compliance can, sign off on borrowing against tokenized funds and in a more legally usable way, and more akin to on-chain repo activities or without clearing brokers and other novel capabilities. I mentioned also the capital math. For anyone who's more nerdy in the way of regulation or SEC filings, as am I, you may have noticed that there was some pretty novel, or rather pretty major changes in terms of stablecoin capital haircuts in February. The SEC released a position on this, and basically it made it such that qualifying payment stablecoins moved from what was effectively a 20% haircut under net capital rules to 2%. And so think about that differently. If you're a broker dealer who previously was doing 500 million in stablecoin settlement, they were probably reserving 100 million at the minimum in net capital, and that's been reduced to 10 million. So just making it more feasible for institutional capital to join the space. And then third, one other point that I mentioned is that, again, there's just more live and in production use cases. I point to Société Générale, the GSIB or French bank, and their collaboration with Morpho, which they're using as the lending backend for their MiCA compliant stablecoins. There are other examples like this, but I think seeing such an example of the GSIB with 1.5 trillion in AUM, doing more in the way of connecting to DeFi global liquidity pools is pretty substantial, and also creates more of a defensible comparable for other institutions that are looking to dip their toes in the space as well.
So we've come a long way from a couple of years ago when there were a number of banks and governments that had sponsored sandboxes that would allow for, I think what Olivia referred to as the proofs of concept, the ability to be able to represent an asset on chain, be able to represent that transfer ownership, and then start to prove out, and this has been that progression of first we have to demonstrate that the technology does what we say it will in representing the asset. Then we have to actually prove out that there's actually a use case and it's not just a solution in search of a problem. A bunch of people say, well, we should just start trading tokens instead of assets across our global capital markets. And so between stablecoins being able to represent more efficient ways to be able to transfer cash for payment purposes, whether it's for retail payments, for the non-banked to be able to get access to banking services, that has been a massively proved out and measurable set of use cases. This idea of DeFi, and I'm going to pick on RWAs, real world assets, assets are assets. DeFi started out as a way to be able to effectively represent banking type services, access to capital, to borrow, lend, the ability to trade and liquidity, and be able to do so on chain in a anonymous and permissionless way. And those words, anonymous and permissionless, don't go very well with regulated institutions. And we all laugh. There was the extreme, absolutely no way it's ever going to happen reactions of a lot of policymakers and governments. But I think what we've been able to migrate from over the last couple of years of not just being able to prove out through these proofs of concept that have real utility associated with them, which is the idea and opportunity to be able to borrow capital in a non-bank pool of capital and be able to get access and be able to have the ability to access that capital in a lower cost and less friction way. And those are important aspects of that improvement of why would any large financial institution pay attention to what this technology represents. And when I look across, not just in the last 8 months, post the change in administration here in the US, prior to that, in Europe, with MiCA, and the legislation there, and seeing GSIBs outside of the US, similarly saying, this technology represents an opportunity and an ability to move capital and to be able to move assets of value, store and transfer those assets in much more efficient ways. So from an institutional standpoint, that makes sense, and that is a set of utilities that can be measured. What is now unfolding, as we're seeing now with more government participation in recognizing the value of this technology, the value of innovation to an overall economic ecosystem is now starting to calculate. I love your idea of math. Institutions care very deeply about math. They care about what the CapEx and the capital expense is for this new infrastructure. They care very much about the operating expense associated with what that means going forward. But even more importantly, what matters the most is the bottom line. And what does this do in terms of new revenue generation opportunities, expanding the range of services and expanding the use cases for capital to be able to allow that capital to go to more efficient and higher value use cases.
You mentioned government participation instead of
Enforcement.
I don't even know if I want to say enforcement, antagonization, it felt like. So now that we have actual participation, I mean, we've seen SEC, Christopher's, Atkins come out. They're making a tour. So I saw them at ETH Denver recently, which was, I have to say, a little comical to have the person with the silver cone foil hat taking pictures of them in suits while everyone is in perhaps more casual attire. But there is real engagement. And so with this engagement, we see regulatory guardrails that are really meant to support innovation instead of hinder that innovation. And so with these changes, we actually see some headway, maybe with Clarity. Let's cross our fingers there. Yield has been a big sticking point, clearly. Which regulatory changes would you have liked to have seen this past year that you haven't, and do you see those on the horizon? So Cynthia, I'll let you start with that one.
Yeah. So there's a lot of goodness actually packed into Clarity, despite all of the continuing negotiations around the sticking points that exist. And that clarity, to use the word, will provide for a common understanding around how to evaluate the tokens and the assets that they represent, so that certainly from our standpoint as asset managers, we know how to incorporate those assets into a client portfolio, for example. We know how to access those assets without worrying about those assets turning into something that they weren't intended to be, and then suddenly having to deal with a liquidity issue for those assets. It very much ties into valuation as well, understanding the nature and the regulatory status for those assets. From a market standpoint and a market structure standpoint, that's also incredibly important from the standpoint of being able to access instruments on chain, being able to see a deep market with liquidity that all investors will be able to access. That is also incredibly important. I do have to say, I've been in asset management for a very long time, and I have never seen such a prolific regulatory agency as we've seen, and the recent pronouncements of collaboration between the SEC and the CFTC. After having witnessed and lived through post Dodd-Frank, 740 pages of Dodd-Frank rulemaking, that was a bit challenged and it's taken about a decade to get through. Seeing that this kind of upfront collaboration among the agencies is I think also extremely healthy from an overall regulatory and governance standpoint. So I think this is good for innovation, and innovation means also business models, which will continue to expand access for investors and opportunities from our standpoint as asset managers.
I would just reiterate the fact that, I've sat on the very regulated asset manager side, now I'm on the, tech side, and so, sat in very different seats, but I would say in my time focusing on digital assets in both posts, it's been remarkable to see just the amount of dialogue that the SEC has been willing to have. I've been to the SEC personally 3 times, be it in the context of the roundtables or just in the context of staff wanting to chat with blockchains and understand what our pain points are, what our policy team's initiatives or priorities are. And so I can really attest to the fact that the dialogue is there and they have really been moving at the speed of lightning. I think that the analogy you made to the Dodd-Frank implementation is a really good one. What's typically taken years has really been compressed in the last year. I'd say more specifically, and I know that the SEC is already working on this, but I would love to see, and our policy team would love to see more clarity, unintended, on the token classification side, and then also ensuring that, and really enshrining in some rulemaking that blockchain infrastructure are not seen as regulated intermediaries, but as tech neutral infrastructures. I think that'll invite a lot more participation, not just in terms of the protocols and primitives building on blockchain rails, but also just comfort by institutions and understanding where exactly their counterparty risk lies. Yeah.
So I think you've also just answered my next question. Do you believe that we have the necessary regulatory guardrails to support development of institutional DeFi? I will say, I don't know if you saw it, but Ninjauer made a post yesterday about this, and he's basically saying, yes, we have the framework, we have enough to work with, we can innovate, but we'd love to hear you.
Well, I would defer to our policy team. I will give a great shout out to our Avalanche Policy Coalition. They do a lot of great primers and have an excellent podcast. So that's my personal, no, I mean, in all seriousness, I think Genius Act was a great stride forward in terms of, clarity surrounding what a payment stablecoin is, what reserves look like. Because obviously, stablecoin is just thrown and bandied around quite casually, and obviously not all stablecoins are created equal. I think there's a lot of synthetic dollars like the Athenas of the world that have been wrongly called stablecoins, and that can misinform retail users and cause issues in terms of institutions even not understanding what's in the fine print of that particular product. That's very different than a payment stablecoin as defined in Genius. And so very excited on the clarity to come on, or rather the clarity that's already arrived on the stablecoin front. I think that'll be really great in terms of seeing fintechs, specifically neobanks, exchanges, wealth tech platforms, and so on, especially in the US, getting comfortable, and also in other jurisdictions that are informed by the US's legal posture. I'd say obviously Clarity Act is still to come, and I think the next best, at least the other clarification I would like to see is really on the yield debate with respect to stablecoins, and I'm sure everyone has seen that, and I know that at Davos it was quite a sticking point, particularly with Brian Armstrong, and some of the central bankers that were in, privy to that panel. And I think more clarity on, again, the yield versus, as some or others are calling, the rewards debate, would be welcome in terms of, proliferation. Although that, of course, also has peripheral, and other consequences, I'd say, for, understanding exactly what, a stable coin is and whether you can opt in to get yield and effectively lend out your stable coin. And that puts into question, I'd say, a lot of the lending capabilities that we know, and have, taken for granted for with banks as it stands today. So it'll be interesting to see that evolution of, users being able to potentially opt into yield, versus, fractional reserve banking that's already kind of done automatically for you and abstracted behind the scenes and props up the whole US banking system as we know it.
So would you say that the optimism towards where we hope Clarity will end up is really allowing this innovation to happen? So you're skating to the puck. So you are ensuring that you're setting up the technology. So as soon as you have those regulatory approvals, you're able to implement the technology, and that's gonna lead me into a question for you. But I think that's it, is knowing that this is the potential, that it's worthwhile to spend the money and development on creating these solutions with the belief that yes, we're moving in this direction, and yes, these things are possible.
Yeah, I would agree. I'd say from my perspective, so for everyone's guide, Avalanche is a network of layer 1 blockchains. And so at the end of the day, we're an infrastructure of settlement layer, and the growth and adoption of an ecosystem hinges on the innovation within it and also the institutional capital that's flowing through it. And I'd say those two aspects very much hinge upon clarity in terms of rules. And so am I partial to any given rulemaking? No, that's not my job, but I do know that the more clarity, or rather rules that are enshrined, the more innovation can occur on our rails, and therefore the more we can bring Web 2 into Web 3.
Beautiful. So Sophia, for you, how in your role, do you balance speed and market readiness within Fidelity's risk and compliance framework? How do you bring your colleagues from legal, risk and compliance, tech together?
Having grown up in asset management and building alternative investment products for many, many years, there's always been this approach that we start with what is the outcome for the client first, and not rushing out the door with new ideas or new structures until we fully vetted from a risk, compliance, and regulatory standpoint, that we understand what those implications are for this new structure. And when it comes to building in this space, as a fiduciary, and again, as a fiduciary, our first and foremost obligation is to our end clients. Abby said this recently, and I can't tell you how many people have played it back to me as this really resonated with them. But as an asset manager, when people give us money, we want to give those people back more money. That's our job as asset managers. And it's very simple, and that's the process that we go through as we are building new infrastructure. We want to innovate and build new products and provide personalized and enhancing that experience of how an investor manages their financial lives. But we also want to focus on what is the impact on the client of the way in which we are delivering that service. We were among the first of the cohort of companies that were able to offer Bitcoin in a brokerage wrapper in that ETP. That was from the very first application to bring that product to market, a decade-long journey. We were there as probably through 5 of those 10 years. in that journey, and we joined when we felt like there was a maturation in that ecosystem. Our teams, the research teams did a tremendous amount of market research, evaluating price discovery, all of the questions that the SEC had before they were going to be ready and to be able to approve that product. So that's the process that we go through. There's a very deep and heavy R&D that goes into the structure, into the markets, and into the ultimate delivery experience for our customers.
And so throughout Fidelity, you would argue there is that alignment on the end goal and high level of collaboration, which I think is key for any institution who's looking to meaningfully adopt DeFi, any technology actually. So, Cynthia, on the note of your innovations, how do you see DeFi being driven currently? So we're taking off a little bit of the regulatory pressure. How do you view your priorities here at Fidelity? Like, what are you most excited about?
Our product roadmap actually has two components to it. One component is to continue to evaluate opportunities in the ecosystem to be able to construct portfolios that give our customers exposure to a broader range of assets, tokens in the ecosystem. And most interestingly, I think, to our overall customer base is the ability to be able to package on-chain yield. So starting with staking across multiple protocols, and as we continue into building out and getting access to on-chain financial applications. So I think DeFi started out with an ethos around pure permissionless. As institutions are evaluating the opportunity to use these on-chain protocols to be able to do fundamentally what the primitives of finance allow for, which is borrow, lend, generating yield. These are financial primitives, and they exist regardless of whether you're on-chain or in traditional markets. And so ultimately, finance is for finance. And so we have a lot of terms to apply to these new business models that are being enabled because this technology allows for representing assets on-chain and then programming how those assets may be transferred or otherwise used on-chain. Those are very, very powerful tools. And we get excited as an asset manager because this gives us more of those flexible building blocks to be able to create new products for our investors.
I would also just really applaud you all in having been early to the space. I think that there's, and I won't name names, but I have a lot of conversations with asset managers that are just getting into the space and are trying to get their bearings and even articulate a roadmap. But I would also just make more of a macro comment that I'm really excited just in the trajectory, especially over the last 12 months that we've seen, just having come from an era of DeFi summer, as they called it, 2020, 2021, where yield compression really created an appetite and an excitement about the space. But at that point, there were 8 to 15% plus DeFi yields that were slightly or very questionable in terms of their sources.
Highly leveraged.
Yeah, exactly. Leveraged bull market, very unsustainable incentives. And more recently, I think we've seen with more rate normalization, 5 to 7% deep in some, again, not to generalize completely, but in some areas of DeFi that are involving like over collateralized stablecoin strategies and that are more palatable. And we're really seeing more of a maturation in the space. And just to put some numbers to that, tokenization is what's making all of this possible. And there are now $27 billion in tokenized assets recorded for RWA.XYZ, which is like Bloomberg tokenized assets. If you're a nerd like me and like to track the space, BUIDL's now at $2 billion. I think Franklin Templeton's Veggie token's now at $1 billion. Another product called USYC is up 40% in the last 90 days. So we're seeing more traction, we're seeing more adoption, and seeing more innovative use cases and utility around tokenized money market funds being on-chain and also composable and deployed into borrow lend strategies. And more exciting, I'd say, utility cases than just copying and pasting a token, an asset on chain, which has its operational efficiencies, but doesn't necessarily unlock novel use cases. And I'd say even around all of that, we're seeing exciting other use cases of operational efficiency being gained. I'm really excited about tokenization in the context of asset-backed finance. Recently, FIS and a company called Intane, which is building on Avalanche, a layer 1 specifically, launched a blockchain-based marketplace focused on modernizing asset-backed finance processes. And so they'll be focused on working with community banks to tokenize loans. And again, in FIS's network, that's north of 2,000 community banks and regional banks, and really enabling for direct securitization and sale of loan portfolios. And while that may sound very boring, it is enabling for more institutional capital to enter the space in much smaller ticket sizes than were previously possible. And again, with FIS's network effects of 2,000 plus banks. And I think with every incremental example like that of operational efficiencies in tandem with novel use cases and tandem with more, I'd say, sustainable yield sources coming on chain and by reputable asset managers, it just, paves the way for even more maturation in the space.
Absolutely. Cynthia, what do you think the role of public blockchains and institutional adoption?
Infrastructure and standardization, and the whole public versus private. I think both will continue to coexist, and if you look at the way in which internet protocols have developed over time, there are the public layers are standardized ways for data to be transferred, and to be able to have that kind of efficiency is what enables private to work. Then there are private layers where there is information, there is data transfer that is not intended to be publicly visible. And you need to be able to have a system that has that kind of composability and functionality. And so from a market standpoint, when we look at markets, markets in the traditional sense, just like markets on chain, there is an issuance layer, there is a trading and execution layer, and then ultimately there's a settlement layer. Your issuance layer needs to have certain privacy-enabled functionality, given you've got customer data, you've got certain transaction data that doesn't necessarily need to have every level of that detail made available on chain. There are multiple ways to be able to ensure that, so you don't need a private blockchain for everything. But I think privacy is an incredibly important part of the overall composability of how finance is going to migrate on chain. Your execution layer, this is where our public exchanges, ATSs, broker dealers, dark pools. There are so many different heterogeneous ways for there to be that transfer of data for order formation and execution to happen. And so you need both public and you need some private, or at least permission protocols to be able to facilitate that heterogeneous type activity. And settlement is the one that I would say, in order for there to be finality and trust, there does need to be a neutral settlement layer. And this is where I think it's harder to compromise on a lot of the private chains. That's great, build on our chain, and only whitelisted people can come and trade on the chain. It's a very small ecosystem that you end up with.
Yeah, and I would, just on that last point, if anyone has followed previous initiatives to enable for institutional DeFi, Aave Arc a couple of years ago was one such example, and liquidity was the biggest issue in that permission, private permission environment, and only having a certain number of whitelisted participants really killed the project. I think at last I checked, it was only $50,000 TVL, and that was expected to bring on like massive institutional workflows and capital. We learned from that now that we have Aave Horizon and have learned from that failed experiment. But I would also add on the privacy piece, it's interesting, the debate has really evolved from this, what I found to be a very tribalistic view of the fully public permissionless chain camp and then the private permission camp, and they weren't talking to each other, and it was very, very aggressive at times. But now I'm really pleased to see that I think the consensus view is that there's a hybrid world where you can have public permissionless chains for certain workflows or private permission chains for other workflows. And I'm biased, but Avalanche's architecture enables you to either operate on our public permissionless chain, which is where the liquidity hub is, our liquidity hub, where the stablecoin market cap, much of the stablecoin market cap exists. It's where the blue chip DeFi protocols like the Aves and the Morphos are. But you can also spin up your own layer 1 blockchain that's private permission, or public permissionless, and really customizable according to your enterprise or institutional or regulators' requirements. But I would say, even in the context of public permissionless chains, there have been a lot of exciting innovations in privacy, such as token standards like the encrypted ERC token standard. That enables for privacy, but also with full auditability. So you can do things like obfuscate, sender-receiver information or balance information, things that obviously should not be public and are very sensitive information as an institution. But you can also enable for the auditability such that regulators can, if they're designated authorities, look at certain workflows of an institution. So I'd say that it's not, again, this either or, but now very much a hybrid world where we're seeing either customizable chains where you can build any kind of instance that you're looking for, or operate in a public permissionless environment with, again, token standards in place to make it feasible.
So what I'm hearing is that instead of just saying we have this wonderful technology and let's just make a nice use case, and if it works, fantastic, and if it doesn't, well, let's do something else. What I've just heard from both of you, which I think is so powerful and meaningful, is that it isn't about one technology or the other. We're not picking one or the other. We're at the point where we can be very thoughtful about how we employ each component of the technology. And we don't get to make these blanket statements that, oh, this one's bad, this one's good, this is great for private, this is for public. And what that does, I think, is it really allows, what I hope, I should say, is that it will allow the public to feel more comfortable. I was talking before the session about how the public, for reasons we understand, can be so fearful of this space. And so we're talking about the use cases, real use cases, where you're leveraging the tech for the end consumer. That's what you started off with. That's the goal in mind. That's what Fidelity uses as their area of focus, and really a way for them to know that we're collaborating, right? So I just think that's incredibly exciting, and it's something we didn't hear a few months ago when I was here last time, is the different use cases and the positivity around it. And again, navigating each of the uses of all of these technologies. I like that nobody's the bad guy. That's refreshing. And so,
yeah, I would say also, just to add to that point, I think in fact, in any technological upgrade, you have to start with where the demand lies. And so
absolutely.
There has to be a use case that demands blockchain or tokenization or smart contracts on the back end. And I think actually the metric for success is when everyone recognizes tokenization is actually quite boring as a technology. I get excited, I'm sure a lot of people in this room get excited about it, but the recognition that it's a boring technology, but that happens to power innovative use cases, novel revenue streams, create cost efficiencies, offer products and services. I see this a lot in Latin America, for example, like access to USD, which often, in the US we might take for granted, or USD savings accounts, or automatic yield on payroll, or these types of capabilities that are not as easily accessed in many areas of Latin America. That's just where I specialize, but there's other areas of the world too, and which can be made possible by tokenization on the back end. And again, end users can in fact know or
or care that, and read the disclosures to know that it exists, but they don't really need to know or care. It's like, when we go to our computers, we're not always asking like, is AWS on the back end of this? Like, there's a reason that that's obfuscated and made, or, invisible to the end user. We just know that it works well.
Yeah, I usually think of email when people start asking me, oh, I don't know about this. You send email every day, and do you understand the entire underlying infrastructure of your email? But do you hesitate to use it? Does your grandma hesitate to use it? No.
Now our AI agent sent email, so.
That, fantastic, yes. And what you said earlier, I thought was a perfect, going with that example of private network and public network and how you're accessing your emails, information at work. We're used to that. It's very comfortable. So I think it's really a matter of taking these things that have a lot of maybe negative hype around them and maybe making them a little boring, as exciting as some of us find them. I think it's really explaining it in a new way. I was at an event in Nashville recently, and someone was giving advice to the Bitcoin community to not talk about Satoshi when you're talking to investors. Don't mention Satoshi. Don't mention philosophy behind it. Just tell them, what are you doing? How are you helping? And that's really what you're doing when you're talking about how can we help our customers? What does that look like? This is all the infrastructure behind it.
We're not selling generic tokens. We continue to sell financial solutions, and how we deliver them needs to be seamless and easy for the customer to access, and that's continuing to be our focus.
Yeah, and I would say also that I think this solution will be remedied over time, especially as more institutions adopt the tech for actual tangible use cases. And just a few that I reference a lot, especially with investors that may be new to the space, is, look at Broadridge and their 400 billion in daily tokenized repo trades, or JP Morgan Connexus doing 1.75 trillion in tokenized repo trades. And the number of examples where we're seeing actual cost efficiencies and benefits to tokenization are increasing, and I think that will help make the case, and there will be a time where we don't have to make the case for tokenization, and it'll be just known that BlackRock's BUIDL is accepted as off exchange margin collateral, and that'll just be a fact. It's more efficient, right?
All right, so I want to make sure we leave time for Q&A. So, final thoughts. Where do you see us in a year? This is a famous question that I think we always ask at the end of these events. And then we're going to look back, because this is recorded now, so we can actually go back to your statement within Fidelity.
Yeah. Well, within a year, I would like to see that we will have a Clarity Act on the books and working towards implementation. That we will continue to see more institutions really embracing what this technology will enable in the way of capital movement, capital access, and investing. There's a lot of infrastructure that has yet to be built to be able to leverage this new technology. So the technology is one component, and the technology is heterogeneous. There are multiple chains that have different use cases and performance metrics around them. But there needs to be applications, and there needs to be hardware to be able to access and power those applications, and that has yet to be fully calculated in terms of what that longer term investment is. So we are still in the early stages, and a lot of this is because the infrastructure is still in the process of being designed.
I'll make the high level bet that we will see an increasing convergence of blurring of the lines between TradFi and DeFi. More specifically, I'll give some numbers to hold myself accountable to. I'll say that we'll see 10 Fortune 500 companies adopt stablecoins meaningfully. I'd say just
10 more.
And more, yeah, yes, 10 more, sorry, 10 more. That's probably very low estimate, but underpinning that, I just want to give a few, reasons for that prediction is if you look at hiring trends, for example, Frank Shapiro, he's FinTech Frank on X, if you're inclined to follow him, does a great job of keeping up with the job postings at various TradFi incumbents. And it's interesting, I think Fidelity had actually posted some product roles related to DeFi and focus on Oracle risk, and you don't have to comment, Sophia, but there will be, an increasing staffing of incumbents with respect to digital assets to build out the infrastructure, as you put it. And I'm also really excited to see more of the blur between TradFi and DeFi, especially with more cases of the Apollos of the world buying like 9% Morpho tokens, or seeing BlackRock get increasingly involved with Uniswap and Uniswap X, with it being supported there, and more KYC friendly, I call it DeFi workflows enabled. And so I think maybe we'll see 5 more partnerships of a similar nature with the DeFi TradFi conversions agreement.
You all heard it.
I'm being very, very conservative, and we'll come back next year and we'll be like, Olivia, really, we could have upped our numbers.
Add more zeros.
Yeah, exactly.
Yes, absolutely. All right, great. So with that, I'll go ahead and open. Yes.
So,
Good to see you.
good to see you. So there was a lot of talk in terms of real world asset tokenization. What are your thoughts on how a lot of this sort of on-chain infrastructure and transparency tokenization can affect how we deal with hypothecation between different categories of assets, especially asset-backed securities, and therefore derivatives, in being able to build associations of derivatives between different assets that might exist on different chains or with different custodial parties in a way that creates much more transparency and less of this paper settlement issue between a whole bunch of different derivatives, and whether they settle or not conditionally is based on an underlying asset that's held in a way that you just can't have visibility into.
Maybe I'll start.
Yeah, absolutely. Take it away.
I'd say certainly one of the things that the programmability of these assets allows for is that number one, the ability to be able to restrict certain transfers, and on chain within a DeFi protocol. There is a lot of ability then to be able to track that transfer application. I think in particular, and I'm thinking of a couple of DeFi protocol ecosystems specifically, where risk management, there is much more focus on that cross margining across protocols or across the primitives within the protocol. If you're crossing protocols, and then you started talking about cross-chain, it does become a bit more of the risk manager's role then to be able to track those assets as they are migrating. So with the transparency that is available on-chain, I'm happy actually to see the number of these risk management teams that are very focused on tracking those assets. So I think the sophistication of risk management has really improved in the last few years, and particularly since DeFi summer.
And I would add to that, there will be an increase in the standardization, especially at the token standards level, to support the hypothecation case that you just mentioned. I point to one specific use case, or one specific token standard, which is the ERC 3643 token standard, and there's an association with it that's growing quite rapidly. We've worked with them on a number of use cases, but what that enables for is, to Cynthia's point, programmability, but specifically so that only users that are KYC can access a certain token, and that there are also transfer restrictions on that token, so that for example, only whitelisted wallets or addresses can in fact access a given token, and therefore you can account for the counterparties involved. And so all that's to say, that's just one example. There's others like ERC 4626 and other exciting token standards that I think will really help to reinforce the maturity of the space, but more specifically the hypothecation issue that you raised.
So I work closely on the client side, whether for better or for worse. So, you mentioned like the sort of synthetic stables of Athena. People will try anything, obviously will be really excited about sort of yield prospects. I guess when you're looking at what types of new assets or sort of crypto assets that you're bringing to clients, and as like a Fidelity client myself, I appreciate that. How do you evaluate, or how do you think about, like, is it criteria, is it vertical? What are you looking for when you're evaluating these new categories?
Everything. We have a research team that does their own research across the ecosystem. We don't trade across every token that either gets launched or otherwise exists. We tend to focus on liquidity first and foremost is important. We do care very deeply about what we think of as the long-term value accretion prospects of any particular token. And so from that standpoint, the research team does look across the user community for that particular token, what the use cases are. From a project standpoint, we have also been looking across the finance sector. We've been looking across DeFi, and our research team continues to do due diligence. But before any of those tokens make it into either a liquid portfolio, size and liquidity are incredibly important. Many of them are still at the venture stage, which don't make it into a liquid portfolio. And then otherwise, as we continue to look at alternative portfolio construction, we look at everything about the long-term prospects of that ecosystem.
Yes, thank you for a great session. This question is primarily directed to Cynthia, but Olivia, happy to hear your thoughts as well. So I've heard the conversation of institutions wanting to serve on-chain products in which there's visible demand from their clients. So how would you say Fidelity approaches this sort of product development and market fit process? I know you mentioned finance is still finance, but does this process with clients differ with on-chain products, would you say?
So you're saying targeting on-chain investors wanting to access on-chain products?
Or just investors in general who don't know that they necessarily want to be on-chain products?
Okay, yeah. So you've unpacked a few different dimensions to that. The first of which is what I would say is on-chain assets in an off-chain wrapper. And that comes straight from the demand that we hear and see across our existing platform. Traditional investors who want access, and sitting in this room, Fidelity offers a range of ways to be able to access on-chain assets. You can access them directly through our retail offering. You can access them through our brokerage platform in the brokerage wrapped product. And again, I would say we don't offer every token that comes there's a lot of diligence that goes into the process of how we are developing our product roadmaps. From the standpoint of on-chain investors interested in on-chain products, our first product that we launched on-chain was the tokenized money market fund. And that was looking at addressing what we were seeing as opportunities for on-chain investors to be able to get access to yield through the tokenized money market fund, to be able to use that token, because otherwise we do actually have quite a few crypto native investors that actually are traditional money market funds. So another big driver in how we came to the conclusion of moving forward with the tokenized money market fund is there are use cases for that token that you can't do with your brokerage account holding a traditional money market fund. And so the posting as collateral, the ability to stay on chain. And so addressing investors where they are, so on-chain investors wanting to stay on chain, wanting to have the ability to demonstrate the transparency of the reserves, and being able to see on either scan that here's the token right in my wallet. So those are all the things I factor into how we think about that product roadmap. And right now, we are much more focused on continuing to build out the functionality and deepening the use cases for that asset, because there are so many more use cases that Olivia talked about quite a few of them that already exist. And so while the space for tokenized money market funds continues to get more crowded, the use cases and the utility is where there is now differentiation.
I know you're gonna send me to your compliance department, but I'm gonna ask it anyway. I'm curious on your personal opinion, besides stable coins, not related to stable coins, what's the most important thing that is missing from Genius Act?
What would your compliance team say?
I don't know that I have a great answer for that one.
I'm talking about just blockchain.
Oh, what's missing from the Genius Act?
I'm sorry?
Is that what your question is?
My question is about the blockchain regulations, besides stable coins.
Oh,
Okay.
okay.
I heard genius.
Yeah, I did, okay.
I mean, I alluded to this earlier, but I think really would reemphasize that it's important to view the blockchain infrastructure as a tech neutral settlement layer and effectively not a regulated intermediary. Because you can imagine the number of rules or restrictions there might be on Avalanche in particular, in this case, and in terms of the builders that we've been enabled to build on what is a public permissionless chain where everyone should be able to launch, irrespective of whether they're, in a certain jurisdiction or irrespective of whether they're from a certain accreditation in terms as an investor, et cetera. So I would say really enshrining that into some rulemaking would be what's missing at this point. I think that'll be resolved as far as I can tell, and based on what I've heard from the Hill. But again, not enshrined in law yet.
Yeah, I have a question. So there's kind of been like a Cambrian explosion of like agentic infrastructure being built in crypto, and a lot of it's been like, big hype, and but it's found some legs, particularly within DeFi, among other places. And I'm kind of wondering, are institutions hearing whispers of this sort of infrastructure being built up? Because it's one of those layers that maybe has the biggest protocols that only have tens of millions of dollars, but it could, very possibly go into the billions, a lot like DeFi did. So I'm curious, what you guys' thoughts are on that.
So on AI agents, I don't claim to be any expert on this, we have an AI team, but I just think it's very interesting to think about from a distribution perspective for tokenized assets that, you can segment your ideal customer profile in so many ways, assuming they're human. And I've realized that, like the other day, I think I tongue-in-cheek did a LinkedIn post and was like, actually, the biggest consumer of tokenized money market funds going forward may be your AI agents, and what they deem to be, suitable for their automated portfolio management process. So that's something that I tinker with, and again, over probably a 5 to 10 year plus horizon. I don't think that, as much as the headlines may suggest, I don't think that as much as I'd like, agentic commerce to materialize tomorrow, I don't think it's over such a short time period, because at the end of the day, there's also not rulemaking about whether AI agents can in fact manage your money. I know like X402 and some other standards are emerging to enable AI agents to do payments on your behalf, but there isn't, again, to create scalability and I'd say a critical mass of usability. There simply just aren't rules around the intersection of AI agents and financial assets at this point. But they could very well be, the best demand or distribution channel going forward as far as tokenized assets go. So that's something that I think about, when I'm falling asleep at night. It's like, maybe actually it shouldn't be pitching RAs or FAs, it's the AI agents.
Yeah. I think there's a couple of things. AI agents in finance and in fiduciary activities in particular is, as Olivia said, a much broader policy question. There's certainly been a great deal of interest in that cross-section between AI and crypto/blockchain, and a good portion of that could very well just be that, the speed and velocity and scale that blockchain supports in the movement of value and money really does lend itself to an agentic economy. But how that all will eventually, right, be allowed to play out, or the robots will take over and take over themselves, is still, I think, a story yet to play out.
We'll be hosting our panel next year.
There you go.
You mentioned the desire for standardization, and just to kind of come in on the comment right now about AI agents. We do work from a cybersecurity standpoint, and curious as to what standardization might be from your side as far as what cybersecurity reviews are conducted, frequency with which they're conducted. Also, to add to the consideration around AI agents, every AI agent represents a new attack surface. So I'd be interested to see how you see cybersecurity as sort of fitting in to what your overall planning and approach is. Not only in AI agents, but more importantly, just digital assets to start with.
Security on chain and elsewhere. The good news for me is I have an incredibly talented and very deep team of experts in our enterprise security group, and this is very much their everyday focus.
I would just add, just for your own reading, and I'm not a cybersecurity expert by any stretch of the imagination, but I would recommend reading some resources from TRM Labs. And there are a few others, but it's in the way of, I just appreciated their research in terms of what on-chain security monitoring can look like. And they do a lot of work also on attack vectors or surfaces.
All right.
One more question, perhaps? So this goes actually at governance, the GRC related question. So, as you touched on essentially the blending of DeFi and TradFi, now that the stress can be, from the traditional to a private credit can be transferred into a DeFi lending platform. Let's say if a borrower drains a credit pool, how that can easily initiate a drain run, so to speak. How do you see, as a infrastructure provider as well as an asset management firm, institute type of control to prevent that kind of potential bank run?
Well, I'd say that any institution considering becoming more involved in DeFi has to, obviously there's a traditional underwriting framework that they've already had in place, and risk management framework that they've already had in place, but what really warrants more thought is the smart contract risk or audit process and framework, which obviously doesn't really have an exact analogy in traditional finance, but could help with what I think you're alluding to, or smart contract exploits or Oracle manipulation or risk issues. And there was just last week a $2.5 million Oracle exploit. I think it was Venus was the name of it. But anyway, all this to say, I think a lot of that will be formalized in the way of institutions creating frameworks dedicated to smart contract risk and using audit platforms like OpenZeppelin or Spearbits or the slew of other audit firms which now exist. But I think in the future there will also be just more continuous monitoring as AI adapts and can really step in, not to replace wholly these audit firms, but support them. And so instead of getting a one-click snapshot or audit, you can have more continuous monitoring that can help prevent the frequency of exploits that we've seen. Though they have been trending downward as the space has matured. But they're expensive too, is what I would also say, is that at least in our ecosystem, even the most bare bone audit is quite expensive. I think that'll improve again over time with AI, but it is definitely a framework that has to be formalized more in institutions.
All right, everyone, that brings us to the conclusion of today's panel. Thank you so much for joining us today. Those joining virtually, thank you as well. And we are going to head over to the cafeteria for some networking, some light appetizers and drinks, and then we have a book signing with BBA founder John Hargrave, who's a crypto investor, so he'll be signing books. Thank you so much, Fidelity. Thank you so much, Cynthia and Olivia. Okay, thank you so much.